your strategy is highly focused with just a few positions. So, why the focus on quality and concentration?
The focus on quality and concentration in the Portland Focus Plus funds is to help them achieve their investment objectives, preservation of capital, and a satisfactory return. The higher quality companies with stronger balance sheets, for example, are better able to withstand adverse events, and that helps preserve capital, the avoidance of permanent losses of capital. And also businesses that if you focus, which is the other criterion, is enables one to cherry pick, say, the best businesses that say are the most attractively valued at the moment. They're often out of favor for temporary reasons, and not be hostage to returns that the indices might achieve, because stock market indices can be propped up by, as we've seen recently, by very high valuations of large capitalization companies. And that unfortunately means their future returns might be lesser, but by cherry picking a focused portfolio of businesses that are out of favor, that are attractive valuations with big upside, little downside, that helps drive the rate of return and the preservation of capital.
So, Jamie, we've talked about the five laws of wealth creation, and if we look specifically at the fourth law, we talk about the prudent use of leverage. Could you tell us what does that mean to you, and what part has it played in your fund's performance?
The prudent use of leverage of other people's money has been a critical factor in my success financially since I started in the business in 1983. And then I was able to use all those learnings over decades to apply them to the Portland Focus Plus funds since their inception in 2012. And in fact, that was critical to even launching the funds, because I went to Michael Lee Chin in 2012 and said, I've got this idea for a fund, and I will put a lot of my own money in it. Now, I mentioned a specific number.
Yeah.
And he said, well, that was good enough for him to back the fund, but he really wanted to know, how did I create that number X, that I was proposing to invest? And it was exactly the way the Portland Focus Plus funds have been managed: focus and leverage. The borrowing rates, we've been over the last really many years, ever since the global financial crisis, most of that time we've been in a period of low interest rates. And so we've been able to borrow in the Portland Focus Plus funds at much lower returns than we have enjoyed in the common equities, the total returns, capital gains, and dividends, and that has enhanced the fund returns. For example, right now, the borrowing rate in Canada for our margin facility is 3.5%. And if we're able to invest at a higher rate of return than that, then it pays us to borrow money and to invest in equities. I find that many people in Canada are, frankly, of two minds on leverage. Many people have employed leverage, and very successfully. If you, how many people in Canada have bought a house for all cash? Not too many. Most have used a mortgage, to help finance the purchase, and the house is appreciated over time. Well, which has helped them drive a higher rate of return on their equity than they could have. In fact, they wouldn't have been able to buy it without the use of leverage. So that's been a good use of leverage. And I'm doing this similar thing in the funds with two key differences. The leverage percentage is typically a lot lower. Like, for example, the funds have averaged about 50 cents of margin borrowing for every dollar of net assets over the long term. That's, in my opinion, enough to enhance the rate of return without imperiling the capital. I always operate on the assumption that a bear market in stocks could happen at any time. So you need to leave a significant buffer so that you're not forced out at the bottom through margin calls. We've never had a margin call in the history of the Portland Focus Plus funds, and I don't intend to start. The other key factor difference between what we do in the funds and mortgages is that in the case of the funds, the mortgage, the margin interest is tax deductible. we pass that along. And for the investors in the LP version, we're non-registered, and on T5013 slips every year as a part of the component of carrying charges, and they are fully deductible from income for tax purposes. So it not only enhances rate of return, but the leverage is also tax efficient.
When we talk, often a big theme here is we often talk about investor role models. You know, role model, recipe do the same. And so for you, who would you say have been your investor role models?
Michael E. Chin is certainly an investor role model, our chairman and controlling shareholder. His unwavering commitment to long-term investing has been very inspirational. We at Portland also use Warren Buffett as a role model, and I'm certainly a student of Buffett and his longtime partner, now the late Charlie Munger, who was a tremendous investor in his own right. They, in turn, developed their investment philosophy from a variety of investors, most notably Benjamin Graham, who was really the father of value investing. So those are a few of the key people that have influenced my investment philosophy.
Um, these markets, and when you talk about Ben Graham, he often told the story of Mr. Market. In your From your perspective, who is Mr. Market, and what advice can we garner from the Mr. Market story?
Benjamin Graham often talked about or wrote about Mr. Market, a mythical investor who was manic depressive and in which you are a partner in a business. And he would come in some days when he was depressed and offer to sell you his part of the business at a very low price. And other times he would come into the office and offer to buy your share of the business at a very high price. And one of the beauties of it was that you didn't have to accept any of his offers, and you had the freedom to do nothing. And that every day he would come in and make a different proposal to sell low or buy high or vice versa. And you could choose to act only when the circumstances were favorable for you to act. And we've certainly seen that many, many times over the years, including in 2025, that investor mania has given way to investor pessimism, and that volatility creates opportunities for the long-term investor. That is one of Warren Buffett's expressions. Volatility is the friend of the long-term investor because it creates opportunities to buy low and sell high. And we try to take advantage of those opportunities.
So, Jamie, we're in a time of heightened volatility and a time of political uncertainty. There's market swings, there's news of tariffs, and there's a lot of economic noise happening. And so I'm sure you've seen a lot over your 40-year career. So for you, how do you navigate these moments and how do you find clarity as a portfolio manager?
In navigating periods of high turmoil, it's very important to block out the noise. So don't listen to your in this aspect, don't listen to your friends and family, well-meaning, people that everybody has an opinion, Uber drivers, whoever it might be. You've got to block out the noise. Remember that common stocks are part ownership of businesses. And so if you've invested in good businesses that are well managed in strong financial positions and good track records, good prospects, that moments when they decline in price, when they go on sale, those are moments to buy more if you have the resources to do so, not to sell. At a minimum, you should gut it out through those periods. And Benjamin Graham talked about buying your stocks like you should buy your groceries. When they go on sale, when things you like go on sale, you should buy more of them. And that seemingly simple lesson is unfortunately lost on too many people, has been my experience, who panic out in adverse times. And there's an old saying that I believe in: no one ever got rich, selling into a panic.
Excellent. And for wealth-seeking investors out there, in various stages of the investor life cycle, what advice do you have for them?
The advice I have for investors, advisors is to, again, among the three major asset classes, common stocks, cash, and bonds, is to invest in common stocks. They have delivered satisfactory returns over the long term, generally over periods of 10 years or more, superior and often really superior to the returns available in cash and bonds, and have done so in a more tax efficient manner and with better inflation protection. I think that you know, compound interest works both ways. It works in enhancing your rate of return. It also works in eroding the value, the purchasing power of money. That if you have a 2 or 3% inflation rate, that is tremendously destructive to over the long term to the value of money. And so the best protection, I believe, against that is ownership of common stocks.
And what role do you think framework has in the control of one's emotions?
Uh, I think framework is very important, and getting back to what is a common stock, it's part ownership of a business. And so you should know, why are you an owner of that business? What is it that you like about it? The management, the products, the services, the financial strength, free cash flow generation, the prospects, diversification by industry and geography, perhaps, and uh, and it's going back to first principles, and what is the valuation of that business? What is it intrinsically worth? And if you've done that homework, that helps give you confidence to weather inevitable periods of adversity in the business from time to time, and certainly in markets from time to time.
We've been hearing a lot of news about the tariffs. Could you maybe give us, in your view, what is the impact of these tariffs on the global economy?
The impact of tariffs is, I believe, different than what the U.S. administration believes that it is. Most critically, I believe tariffs are paid by the importer, directly or indirectly. Whereas the U.S. administration currently seems to believe that it's paid by the exporter. We see this in the stark tariffs that have been levied on China, and the administration's view that this will bring China to heel, when in fact I believe that China will just wait it out, because the impact on U.S. consumers will be so negative, that I believe the administration will have to back off. And more broadly, beyond tariffs, this is just another example of negative events that come from time to time. And I believe in the old Persian, adage, "This too shall pass." Those are great words of wisdom. I believe this is not sustainable, and therefore it will end. In the words of economist Herb Stein, who coined Stein's law, if something cannot go on forever, it will stop. I believe that the tariffs, as they have been implemented, cannot go on forever. So there will be change.
Jamie, can you tell me what investors are best suited for the Portland Focus Plus funds?
The investors who are best suited for the Portland Focus Plus funds are those with a genuinely long-term orientation, and who understand that common stocks are, or share my opinion that the common stocks are the best long-term wealth creation vehicle among the major asset classes, and who have the fortitude, to not panic out during inevitable periods of market decline and dislocation. So it's an equity orientation, genuinely long-term view, because many people say they have a long-term view until there's a bear market. As the boxer Mike Tyson famously said once, everyone has a plan until they're punched in the mouth. And unfortunately, bear markets weed out the people who don't have that genuinely long-term view and fortitude. And it's just, I've seen it so many times. It's just terrible to see it, that people buy after a period of enthusiasm when stock returns have been good, and then sell out after a period when stock returns have been bad. That's a recipe for impoverishment. The recipe for wealth creation is to hold on for the long term, buy more if possible during periods of adversity, and emphasize common stocks, I believe.
Very good. As your role model, Warren Buffett, said, be fearful when others are greedy and greedy when others are fearful.
Exactly.
So what message do you have for advisors that are really looking to, stand out, deliver exceptional results, and, deepen their trust with their clients?
What advisors need to do, I believe, to best serve their clients as well as to grow their own businesses, emphasize long-term, compounding, long-term investing, and that, I believe, means emphasizing common stocks as opposed to cash and bonds and similar instruments like that I believe will have lesser rates of return and be less tax efficient. And it's important to establish what your framework is. What is your wealth creation formula? How are you going to add value to clients over what they might do themselves? I think one of the most important things financial advisors can do is to try to have that framework and be able to articulate it to clients. For example, common stocks being part ownership of businesses, and get them through, do the hand-holding to get them through inevitable periods of market downturn. That's where I see investors make some of the biggest mistakes, is selling out in downturns. And I think that's a way, with having that framework, that financial advisors can add significant value to their clients.